There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, today I want to talk about the stop losses that you should be using with your technical analysis. If you're trading stocks, you need to learn technical analysis, which is the reading of the stock chart for that particular stock, index, ETF, or whatever you are trading. You can't just trade on recommendations because you're going to lose money. And I know a lot of you are already. One of the key factors of trading that separates those who are very successful and earn very high incomes from the stock market versus those who make a little profit, then lose the profit, and then lose more money, and then make a little profit, and lose, and at the end of the year they have a loss in their trading account. You shouldn't be trading if you're having a loss in your trading account at the end of the year. What are you doing? The whole idea of trading stocks is to make some sort of monthly income or annual income, right? So you have to learn to use stop losses. Now, a lot of you are going to go, oh, stop losses don't work. Stop losses don't work. Well, sure. If you're using the outdated, ancient, antiquated, useless percentage stop losses that are taught everywhere, of course you're going to get stopped out. Of course your stop losses aren't going to work. Why would they? HFTs can see the percentages. They know the percentages. All they have to do is write a little algorithm and wham, there you go. Retail brokers can also take advantage of that. Don't use percentage stop losses because you will find if you learn to read charts and use technical analysis that most of the time a percentage stop loss is smack in the middle of the way of rotation, buy zones, sell zones, all these different things that are going on in the market. They're right smack in the middle or above support or below resistance. So you're going to get whacked because the percentage stop loss is for an amateur, and you should not be trading like an amateur or a hobbyist. You should be trading like a professional, and I mean a real professional. Not those guys who have 3-day seminars or weekend seminars and then try to sell you a $50,000 or $100,000 course. Talking about real professionals. Professionals who you never hear about because they're making a lot of money and they like to stay under the radar. They don't go around doing all the stuff that you see on the internet. They are pretty much invisible because they're making money. They don't join chat rooms. They don't follow tweets. They don't follow stock twits. They don't use recommendation services. They don't use IBD. They're not part of AAII. They don't listen to their brokers. And they use semi-professional to professional platforms for their trading because they need a more sophisticated broker than what most of these brokers offer. They also know that the training that the brokers offer isn't anything near what they need, and they have gone and sought out very quality education. Stop losses will work if you use the proper support level for the time frame in which you are planning to hold that trade. If you're swing trading, there's a different stop loss level, a different type of support, and so on for your stop loss at which you have to place that stop loss below that support level, below the lowest low. Then there would be for a position trade or an intermediate term trade or a day trade. If you're scalping, that's day trading intraday. Scalping is intraday day trading. If you're doing that, because there are a lot of companies right now that are trying to teach you this completely outdated and useless day trading strategy that you'll lose a lot of money on. Maybe you'll make a few profits early on, but you're going to lose a lot of money. Then you can come back and we can talk about it. But they'll tell you to keep a very, very tight stop. Well, that is going to cause you to have stop loss whipsaw takeouts. What you don't understand is that it's not enough just to learn how to read candlesticks. It's not enough to just learn trends and different things that you learn in technical analysis. It's not enough to use stock indicators. What you have to do is understand the market structure that you're dealing with today, and it is absolutely 10,000% different than it was in the 90s, and most of the training out there for retail traders was designed in the 80s and 90s, and it doesn't work anymore. The stock market is now fully automated on the professional side. Fully. They set orders. They trigger on specific sequence of events in price, volume, lot size, time, and so on. So if you set your stop loss at a level where there is a buy zone trigger for a TWAP modified volume order that has a multiple leg transaction, because that's the kind of sophistication we're dealing with in the market, and I'm sure a lot of you are going, what the heck is she talking about? I thought there were at market orders, I thought pros used limit orders, and da-da-da. They don't use that stuff. They have very, very complex order systems now, and they're not available to you. You have the limit order, you have the at market order, you have stop loss orders, that type of thing. You're limited. So you have to use them properly. And you have to understand that if a stock moves down and you think, oh boy, I'm going to sell this stock, and then very shortly thereafter it moves back up, what's happened? You have a stock that moves down 2.5 points exactly to the penny. Immediately, in the next minute, that stock moves up from that prior low penny up almost 2 points and stops. And then starts moving consolidation. Daily chart, intraday chart, doesn't matter. What happened? Oh, maybe it's the market makers taking advantage of your stop losses because you set your stop too tight and it just took you out. Nope. Oh, it's your retail broker scamming you. Nope. What happened? You accidentally entered a buy zone where there was an automated TWAP modified volume version order sitting there, or dozens of them sitting there, waiting for that stock to fall into that price zone, and then it automatically triggered. Boom! And then the stock rose as more orders followed that to a certain level, and then it stops. The market is fully automated. You're trading against an automated market. So what happens with that percentage stop loss you put in there, and you get whipsawed out, is that you did not know what was going on, and your stop loss was put right in the path of that TWAP buy that triggered automatically without any human intervention whatsoever. So whose fault is that? It's yours. Because you don't know how to trade the automated market. You don't understand where the buy zones are. You don't understand where the rotation happens. You don't understand when buybacks are occurring, there's also some rotation going on. Trading range market condition is a fractured sentiment market. It means that some of the market participants believe that the market should go down, and some believe that the market should go up. Some are rotating out because they are trying to lower their risk by lowering their inventories of stock held. Others are buying because they're just dead sure that whatever is happening politically will mean that the stock market will go up. It's a fractured market. Trading ranges are the hardest market to trade of all, and if you master trading range market conditions, you are a professional. You buy a stock, it whips you out. You sell a stock, it whips you out. You're so frustrated, you can't understand why you can't make money. You don't need to know anything to make money in a stock market that's moving with speculation. All you do is buy. Anybody can do it. But now, you have to become a professional. You have to learn how to trade these markets. You have to understand where those buy zones are likely to hit. You'll have to understand where a rotation is going to enter. You have to recognize it in the candlestick patterns. Can you? My students can. You should be able to. It's not that hard. You just have to learn what to look for. Stop losses get taken out more often by automated trigger orders because they're placed in the wrong place, because you don't know how to position them, because you're using percentage stop losses, and that is why you're taking losses on your stop losses. Stop losses work if you understand the dynamics of that chart. Who's buying? Who's selling? It matters nowadays because they have automated orders sitting there that trigger automatically. And that's a benefit to you because it sets up certain patterns that are obvious. Oh, that's a buy zone. That's dark pools. Oh, that's a buyback. Oh, that's rotation or distribution. They're easy to recognize once you understand what they're supposed to look like and how and where they form on the stock chart. But you've only learned a couple of candlestick patterns, or maybe you've gone through the entire candlestick book and all these different DVDs, and you know all these candlestick patterns, and still you can't trade and make profit. It's because it's not enough to recognize a candlestick pattern. You have to understand who formed that pattern and why they bought or sold at that point and juncture. Candlesticks are the basics. It's the elementary stuff. And that's very simple to learn. Oh, an engulfing white, it means this. Oh, a hanging man, it means that. Oh, a star, that means that. Oh, a shooting star, that means that. Tweezers mean this and that. Those are easy things to learn. But you haven't learned the most important things. In our automated marketplace, which of those, if any, are actual buy entry or sell short entry signals? Because most of them are not buy entry or sell short entry signals. Most of them are reversal or continuation patterns, which in a trading range marketplace, they're not entries for buying or selling short. They're implications, they're implying of a reversal or a continuation may occur. Candlesticks are not 100% accurate. If you don't understand why they formed and look at more than one candlestick, you have to look at a group of candlesticks over the past couple of weeks and a daily chart for swing trading. For position trading, I'm not talking about positional trading, I'm talking about position trading, which is completely different. For position trading, you're going to be looking at the last 3 months of activity because you're going to be holding that stock anywhere from a couple of weeks to 3 or 4 months. And you're going to be earning much more money than you would swing trading in a trading range market condition. Swing trading in a trading range condition requires precise candlestick entries. Stop losses have to be placed very, very precisely for swing trading. You want a weak to moderate support level that is very close to the entry price because you need to limit your risk. However, if you place it too tightly, you're going to get whipsawed out because of the automated system that we have today in today's market. If you're position trading, you have to have a much stronger, moderately strong support level. And you have to place the stop loss beneath that, well beneath that, because stocks can move through that moderate support and then recover and move back up. So if you place your stop loss in the middle of that support level, wham bam, out you go, stop loss triggered, and it's automatic because those HFTs are out there watching and they know about percentage stop losses, and your broker has to light your orders to the exchanges so everybody sees where you're at, not just your broker. Your broker just takes advantage of the situation quite often because you do not know what you're doing. You have learned a little tiny bit of trading. You've learned a strategy or a concept. You've learned how to enter some orders. You've had somebody sit there patting your back telling you can do this and you should spend another 50 grand, which is obscenely amount of money on training, so that you become this powerhouse trader, and you never will become it because they don't have the training you need. No matter how often somebody sits beside you and pats you on the shoulder, it's not going to make you a good trader. There's a certain methodology to training that I have developed, and it works. You have to do the trading, and you have to simulate trade, and you have to use stop losses. You have to learn how to use proper stop losses and the proper trailing profit stops to protect your profits as you earn them. Because we have a fully automated market structure. We have 9 different market participants, and each one of those have different professional order types or order types for the retail side. They trade different sized lots than you. Some of them are huge. They enter with a specific type of order that's bracketed or controlled. They have stop losses in different places than you do. Their intent or hold duration of the trade is different. Everything about how they trade is different. They're totally unique groups. Some are just a few in number. Some are millions and millions in numbers. You have to understand how they move price, why they move it, why they buy where they do. Understand what that candlestick represents. Who does it represent in relation to volume and all the other things you are learning? You're not learning this stuff, and that's why you're not making money in the stock market. You can do this, but you have to bite the bullet. You have to dare to commit yourself to success. A lot of you are delusional in thinking that you can do this, and you'll continue to lose money. Some of you have been trying to trade for 5, 10, 20 years or more, and you're still not making any money, but you're still trying. And that's really sad. Because by now, you should have long since been so profitable that you could have retired or done trading just for the fun of it and moved on. But you're still struggling trying to figure out what's wrong because you've learned a couple of strategies. You have a few favorite candlestick reversal or continuation patterns. You never learned the buy entry signals. You have stop losses that you place at percentages rather than knowing how to place the stop losses technically so that you're protected from whipsaws. You don't know which order types to use so that your broker can't take advantage of you. There is so much more you need to learn. So the question is, do you still want to just lose money all the time so that you have a loss that you can take on your taxes at the end of the year to lower your overall income? Maybe that's your goal. If it is, go for it. But if you're really serious about becoming a successful trader and you want to earn very high income from the stock market, there's a whole lot more you need to learn. Stop losses work. Trailing profit stops work. But if you don't place them properly, they will take you out before you want to be taken out. It is not the market makers. It is the automated market system. It is the HFTs that can see your orders and take advantage of them. It's your lack of understanding, your lack of knowledge, your lack of experience that's causing these losses. If you want to be consistently successful in the stock market, you're going to have to learn more than you know. You're going to have to bite the bullet, and you're going to have to come and learn what you have not been taught yet. You will be blown away by how much you haven't learned and what you need to know. It's fun to learn about trading properly. It's rewarding to have good profits. It's a lot less stress. It's a lot more fun. And it certainly will make your spouse or family back you when you start making money instead of looking at you wondering, why the heck are you still trading? Because you keep losing money. Stop doing this. Get the education you need. It's right at TechniTrader. Give us a call. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.